everyone, I am Jagadeesh KK, Assistant Professor from the Department of Professional Accounting and Finance, Christu Jayanti deemed to be University. I welcome all of you to today's session. We are going to discuss about depreciation under section 32. Depreciation, that is one of the most important admissible expenses available for an assessee who has income under the head profit and gains of business or profession. Depreciation is available on both tangible and intangible assets. However, there is no depreciation available on the goodwill. Section 32 of the Income Tax Act says depreciation is to be calculated on the written down value of the block of asset. It means depreciation should not be calculated on the individual assets cost or value. For this purpose, we have to group the assets into block of assets. Assets which are of similar nature, assets which possesses similar characteristics having same rate of depreciation can be grouped into one. We call it as one block of asset. Depreciation is admissible only when it is calculated under written down value method. However, an entity which is engaged in power generation or power generation and distribution is permitted to calculate depreciation under straight line method also. The only exception given is for only those entities which are engaged in power generation and distribution. Block of asset is defined as group of asset falling within a class of assets in respect of which the same rate of depreciation is prescribed. Usually, the blocks of asset are furniture, plant and machinery, building, intangible assets. The CBDT, which gives the rate of depreciation on each block of asset. Section 32 says depreciation should be calculated by applying this rate on the written down value of the block of asset. Then only depreciation becomes an admissible expense. Though we say depreciation is calculated on the written down value of the block of asset, there are cases we have to calculate depreciation on the actual cost too, especially when a new asset is put to use for less than 180 days. A new asset means an asset, it can be a furniture, it can be a machine, it can be a building, it can be an intangible asset like trademark, patent, copyright, franchises, licenses. If a new asset is put to use for less than 180 days in the previous year in which it is purchased, half of the normal rate of depreciation is applicable. In that case, we calculate depreciation on the actual cost of that asset. For example, a new machine is purchased on 1st January 2025 and put to use on the same day onwards. We won't get 180 days till 31st March 2025, and therefore we apply half of the normal rate of depreciation. For depreciation calculation, we should know what is the meaning of the actual cost also, especially in case of new asset. Actual cost, apart from its cost price, includes expenses directly related to the acquisition of the assets, including traveling expenditure incurred for acquiring the asset, expenses necessary to bring the asset to the site, installation and make it ready for use, that is carriage inward, loading and unloading charges, installation cost, trial run cost, all these are part of the actual cost while calculating depreciation. Then any expense which is incurred for making the asset fit for use, so repair before installation, component replacement, all these are part of actual cost of the asset. So as per section 32, when we say depreciation is calculated on the written down value of the block of asset, that is applicable in case of normal depreciation. There is additional depreciation available for a manufacturing entity and those entities or undertakings which are engaged in the power generation or power generation and distribution. An assessee who is engaged in the business of manufacturing of any product, article or things is permitted to have additional depreciation apart from the normal depreciation on the new plant and machinery which is used for the purpose of manufacturing of article or things. If the new plant and machinery is put to use for more than 180 days, 20% is the additional depreciation rate on the actual cost of the asset. And if the new asset, new plant and machinery is put to use for less than 180 days, then 10% is the additional depreciation rate and the remaining 10% will be allowed in the succeeding year. Additional depreciation is not available on all plant and machinery, which is available only on new asset, new plant and machinery which is used for manufacturing of any product, article or things. It is not available on ships and aircraft. It is not available on any machinery or plant which before its installation by assessee who used either within or outside India by any other person, which means a second-hand plant and machinery. Any machinery or plant which is installed in any office premises or in a residential accommodation or an accommodation in the nature of guest house, any office appliances, road transport vehicle, no additional depreciation. Additional depreciation is not available even on any plant and machinery whose cost is fully allowed as deduction in a year. On such cases, no depreciation and additional depreciation. Now let us see this provision or application of these provisions with this example. A company which manufactures computer hardware having plant and machineries with total WDV as on 1st April 2024 rupees 25 lakhs. There are three assets originally where they are P1, P2 and P3. Company purchased two new assets P4 and P5. P4 was put to use from 1st January 2025 and the P5 was put to use from 1st June 2024. P4 cost 3 lakhs and P5 cost 2 lakhs. And the company sold P2 in the previous year 2024-25. When we calculate depreciation for this block of asset, plant and machinery 15%. First we need to take the written down value as on 1/4/2024. There are three assets P1, P2, P3. Together the written down value is 25 lakh. And we need to add the cost of new asset P4 and P5. In that P4 was put to use from 1st January 2025, less than 180 days in the previous year, and P5 was put to use from 1st June 2024, more than 180 days. And we add the cost of these two assets, 3 lakh and 2 lakh, with 25 lakh we get 30 lakhs, that is the total. And one of the assets, P2, got sold in the previous year 2024-25 for 2,50,000. So we should reduce 2,50,000 from this 30 lakh. So written down value of the for the previous year 2024-25 is 27,50,000. We are going to calculate depreciation on this amount. As we have a new asset which is put to use for less than 180 days in this block, we cannot calculate depreciation at 15% on the entire 27,50,000. First we need to calculate depreciation on the cost of new asset which is put to use for less than 180 days, 3 lakh into 15% into 1/2. That is half of the normal rate of depreciation is applicable. We get 22,500. And on balanced WDV, we apply 15%, we get 367,500. The total normal depreciation is 3,90,000. As this company is into manufacturing of computer hardware, it is a manufacturing company, it is eligible to have additional depreciation on both P4 and P5. On P4, new machine P4, put to use for less than 180 days, 10% additional depreciation is available. So 3 lakh into 10%, we get 30,000. And on P5, the new plant and machinery which is put to use for more than 180 days, 20% additional depreciation is available. So 2 lakh into 20%, we get 40,000, total 70,000 additional depreciation, and the total depreciation amounts to rupees 4,60,000, 390 normal depreciation plus 70,000 additional depreciation. The key takeaways from today's session is admissibility of depreciation. Law says depreciation is admissible only if it is calculated as per the provisions given under Section 32 of the Income Tax Act. Normal depreciation, it is calculated on the WDV of the block of asset. Additional depreciation is allowed only on the cost of new plant and machinery which is used for the production of articles or things. Thank you very much.